Look, I also think this sort of puts some cold water on the idea that Trump inherited this sort of like rip roaring economy. I mean, everyone that's been following our work knows that we've utterly reject that view. I see some people on the, dare I say it, the fake news New York Times saying that Trump inherited an economy firing on all cylinders, and now after this jobs number, it's all of a sudden getting worse. I mean, that is just a bunch of baloney. You can say that the outlook has dimmed because of tariff related uncertainty. I would sympathize with that. But please, let's not say that he inherited a strong economy. I mean, some of the weakness in markets predates, anything that he did related to tariffs. It was just a response to the data getting worse, right? Look at an economic surprise indicator. A lot of that data reflects data from January when he wasn't even president yet. So I just think it's a bit disingenuous. It's trying to fit something, data to a narrative. We don't like that. But yeah, I mean, I think you'll require some kind of policy response either from Trump backing off, or the Fed.
Welcome to RenMac Off Script. We openly discuss markets, economics, policy, history, and life. It's the 7th of March, 2025. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pallett.
As a reminder, most of the charts that we reference are posted to our Twitter account at RenMac LLC. Well, it is payrolls, and Neil has gone far and beyond to look at the payroll data this year. He's not in a confessional, though it does look like that. Props to you, Pavlik, for knowing what that looks like. Probably more time spent there than you care to admit. Neil, what's going on in not only India, but also with the data this week?
Well, what's going on in India, unfortunately, was that my father was visiting and my mother were visiting relatives out here. And he fell very ill. And so I came out on Sunday. I had to go get an emergency visa from the consulate in New York because I haven't come here in 15 years. So my father's always wanted me to come out with the kids. I still didn't give him that, but this is what it took for me to come out. But thank God.
Is he doing well? First and
On a
foremost,
personal level, I mean, on a personal level, the day I got here, I mean, the hospital that he was in looked as bad as a hospital you would think would look like if you were an American, okay, coming here. But I honest to God thought I was going to lose him when I got here. But thank God he's on the mend, getting better, and will be home to the clear blue skies of New York in no time. So thank God for that. Now, in terms of the blue skies are very important. I haven't seen a blue sky in several days because of the pollution here. But at any rate, in terms of the payroll number, look, I mean, I think it was weak. I don't. Was there a smoking gun? No. But the labor markets are still cooling. If you look at the last 3 months, when you take the sum product jobs, hourly earnings, and the work week, that number is up barely 3% at an annual rate. That's a proxy for nominal GDP. That means that the Fed is running a tight policy, full stop. At this point, you have to ask yourself, what is going to arrest the slowdown in the labor markets? I think it's sort of a body in motion is going to stay in motion. And to me, it just means that, a policy response will be required to slow this down. I mentioned the work week. What incentive is there really for companies to add bodies if the work week is this low? If there is an unexpected turnabout in demand, the first thing they'll do is just increase the work week. They don't actually need to hire more people. They just need to extend the hours of the people that are already working. So that's number one. And I think that's important. Number two concern is you've had over 50% of the growth in the private sector driven by education and health services. I mean, that is unhealthy, no matter how you slice it. And then finally, the public sector, maybe it's DOGE. You saw federal government employment contract by 10,000. But the bigger story is that the echo of pandemic relief is fading, and that's going to start to bite state and local governments. That number rose by its weakest in 3 months, 20,000 or so. But that's set to continue. I mean, everything we know about state and local governments suggests that there's additional weakness in train. So I think, and then finally looking at the household survey, prime age employment fell. It's down 0.2% over the last year. That's highly unusual outside of very weak economies. Um, and I mean, underemployment rose because you had more part-time people looking for full-time, jobs. So you had more part-timers for economic reasons. And that's, sign of slack in the labor market. So again, I mean, the main issue is what stops the bleeding or the cooling, absent a policy response. I mean, people can talk about, oh, well, maybe it was the weather again or whatever else. I just think it's sort of a joke. I mean, just like that's not okay. Maybe that gets you a 1 month bounce, but what do you have beyond that? There's a lot of slowing in the pipeline, and look, I also think this sort of puts some cold water on the idea that Trump inherited this sort of like rip roaring economy. I mean, everyone that's been following our work knows that we've utterly reject that view. I see some people on the, dare I say it, the fake news New York Times saying that Trump inherited an economy firing on all cylinders, and now after this jobs number, it's all of a sudden getting worse. I mean, that is just a bunch of baloney. You can say that the outlook has dimmed because of tariff related uncertainty. I would sympathize with that, but please, let's not say that he inherited a strong economy. I mean, some of the weakness in markets predates, um, anything that he did related to tariffs. It was just a response to the data getting worse, right? Look at an economic surprise indicator. A lot of that data reflects data from January when he wasn't even president yet. So I just think it's a bit disingenuous. It's trying to fit something, data to a narrative. We don't like that. But yeah, I mean, I think you'll require some kind of policy response, either from Trump backing off, or the Fed. And I'm sure we'll talk about this later. But I thought it was a huge tell that Trump essentially backed off the tariffs on Canada and Mexico. I mean, basically saying that everything that's under the auspice of USMCA is excluded, which basically means everything. So we're putting tariffs on everything coming in from Canada and Mexico and excluding everything as well. So but the fact that he said that and markets didn't respond to it is a huge tell. It basically puts the onus more on the Fed to kind of stem the bleeding. So there's obviously a lot going on globally with Europe and defense, US, tariffs. There's a lot going on. But I think for market and sort of market participants and investors, it's concerning that to the extent that if you think that it's a Trump related story, the fact that he backed off and markets still fell means that means basically that there's going to be more onus on the Fed to actually resolve these issues.
So this 3 month rate of change is the lowest that we've seen since basically the pandemic, right?
I mean, it's very weak. I mean, that's
And
I mean,
what was the work week? How big a contraction was there in the work week?
it didn't contract, it just didn't rise. But people were
Okay.
expecting it to perk back up. I mean, it's already at cycle lows, so it's at cycle lows again. But there was an anticipation that it would rebound because of the weather, and that didn't happen. But at any rate, the main point is that, I mean, leave that all to the side, right? If you're focused only on weather, look at the fact that prime age employment fell. But more importantly, the work week would still be low even if there was a weather bounce. So there's really not much reason for firms to add bodies.
Your people love the weather. They love the weather. The weather's always that magic variable that explains everything away. I love it.
I mean, I don't like the weather. I
I
mean,
know
I
you
think
don't.
that that's like it's a useless. I'm not a weather, birth, death, person. I'm just basically like let's stick to first principles person.
Fair enough. All right, Steve, let's open up the floor. I don't even know what to begin with because it's just chaos, and I don't, between noise and I'm finishing up a week out in the snow. And by the way, the only thing standing between me and 18 inches of fresh powder are you two. So let's get this, wrapped up here. But what was your take this week? Tariffs, State of the Union, or whatever the heck that thing was. Doe, where do you want to start? Go ahead. The floor is yours.
Well, I guess we'll go sequentially. Start with it wasn't technically a State of the Union. It was addressed to a joint session of Congress. All presidents since Reagan sort of do this shortly after they're inaugurated. Look, I think it's political theater. That's essentially what this speech has evolved into. And I think as a result, you're seeing sort of actors in this play acting, I guess, what they feel is accordingly. It's a political speech in nature. People that like Trump are going to like what he said. People that don't like Trump are going to like what he said. There were two things that jumped out at me. One was his call to maybe try to repeal CHIPS Act funding. I don't think that's going to happen in Congress. I also don't think there's much money left to repeal, but I thought that was notable because it came after this announcement of TSMC to come here. And I think that's sort of a reflection of the CHIPS Act failure to create Intel to become this reliable domestic chip producer. So that's sort of my takeaway on the policy side. The other thing, if I would be critical of Trump, was sort of waiting 20 minutes or so to get to concerns over prices and inflation. And I think that's one thing, if I'm watching from a poll perspective, if you look, his numbers are actually up in most other policy areas compared to where they were in the first term, but they're actually down on the economy. And from voters' perspective, consumers' perspective, they tend to view the economy by prices. This was something that dogged Biden and Harris during the campaign. And I think Trump is going to feel pressure at some point to do more on that. So that sort of bleeds into what happened later in the week with the tariffs. And I guess they took effect shortly before Trump gave that speech. I don't know if he felt that he wanted to just say that he imposed them. There was this question, is he willing to shoot the hostage? But when you sort of walk them back by providing exemptions to automakers, it just means you're open to exemptions now. Every other industry is going to start demanding these, and they're going to go to their lawmakers whom you're going to need to get your nominees confirmed and your tax agenda passed. So you're sort of opened yourself up there. And then as Neil was saying, then it's sort of like, well, let's go ahead and provide a pause for all USMCA related trade air between Mexico and Canada. So maybe you shot the hostage, but you shot him in the toe. And you actually treated it after you did. So, I'm not sure that's necessarily the message Trump wants to send. He seems to really be putting more emphasis on this April 2nd date in terms of reciprocal tariffs. Nobody's entirely sure what that's going to mean because he said he's going to go beyond just the rate that other countries are charging us in terms of their tariffs. I think it's probably more politically resonates with folks just because the idea of, well, look, this is what they charge us, we charge them, so we'll see. But I think when I look ahead to this week, we have the steel and aluminum tariffs coming. And so are we going to see a similar situation where Trump rolls them out and they're sort of walk back narrative? Is it going to be another pause till April 2nd? I don't know. And then that's sort of what tied into what Neil was talking about. It's just a lot of uncertainty. And even if you sort of walk these things back now, that uncertainty is not going away. And I don't know why companies would want to make a lot of investment in this environment.
And that's the crux of it, right? I mean, you need predictability to make capital allocation decisions, and the longer that uncertainty goes, the more challenging that is.
I mean,
Neil?
part of what's happened though also, guys, is that I do think that they erred a bit by not talking the economy down more on their way in the door. I mean, a lot of what's going on right now reflects that. I mean, you know what I mean? Like you can't say, right? Because now you've basically opened yourself up to the risk that you're going to be the one taking the blame for the slowing in the economy. Because so if you basically said the economy was weak coming in, and I think that, as everyone knows, I've said that they have a very strong case for that. You can't run an economy just on AI data centers. I mean that's kind of that was kind of what was going on towards the you know and people just unsustainably drawing down their savings. I mean that's not you can't keep doing that. So if they talk the economy down more on their way in, I mean they'd be on much firmer ground. First, to not take blame for some of the things that are going on at the moment, but also maybe to kind of put the onus more on the sequencing of policy. I mean. Um, you've heard the proverb, I mean, measure twice, cut once. I mean, that's not really what's going on with tariffs. Um, so, I think if the focus was basically on, trying to kind of add additional pressure to China, I don't think the markets would really take a look at that unfavorably, to be honest. But it's just sort of this haphazard approach with some of our major trading partners that's a problem. But look, I mean, in the administration's defense, I mean, you can look at some things and say, like, maybe there's something there. I mean, the fact that we're no longer the security blanket for the Europeans has finally gotten them to take their own security more seriously, right? And that's leading to some rebalancing of global activity, right? I mean, the fundamental issue is that uh, those countries don't spend enough and we spend too much. So we suck in too many imports from everyone else. And so you have seen some rebalancing, and I think that's welcome. So, I think that also deserves some attention. But I agree with Steve that the haphazard approach is not welcome.
Measure twice, cut once. Well, I didn't know it was a proverb for first and foremost. I'm gonna have to fact check you on that. First time I heard that was from a carpenter, but the best part about that story is the guy had three fingers on his left hand. So I'm like, maybe watch what you're cutting too while you're at it should be the other part of that proverb. Steve, what do you want to?
I was just going to emphasize what Neil said regarding the sequencing. That's one thing I think people forget compared to Trump 1 was, last time you had the Trump tax cuts, reducing the corporate rate from 28% to 21%. You reduced the top individual rate. You did that in 17 before you pivoted to tariffs. So that created a little more margin there to minimize some of the potential disruptive nature. This time around, Trump can go ahead and proceed with tariffs whenever he wants. He has to wait on Congress. And Congress this time isn't looking at providing a tailwind by reducing any rates. They're just trying to prevent a headwind by having the top rate on the individuals move up. So I think that's going to be something to watch if these tariffs remain in place. I think that's the other wild card here too, is you hear all these dire forecasts about, what the impact's going to be, but they're sort of assuming that the tariffs are just going to remain in place indefinitely rather. And I just don't think that's the case. I think that's sort of what the takeaway was back to the uncertainty situation we saw this week is they're on, then they're off. They might come back. They may be lower rates. You might get an exemption. You might not. So it's just going to be a bumpy road, I think, for the next few months, possibly the next few years.
Well, let's be hopeful that this is, a Michelin starred restaurant, and when the entree comes out, it looks fantastic and tastes great. But when you go back in the kitchen, it's a effing disaster back there, right? I mean, that's all you can hope for at this point.
I think that's the hope. And to the extent that there's a strategy, a big picture thing, like Neil mentioned, there is some effort here to get other countries to bolster their defense spending so we can spend less, given our fiscal situation. I think there's some merit to that. I also think there could be some strategy, maybe difficult to see now to your point about the kitchen, where can you sort of force these conversations with respect to Canada and Mexico, secure that America trading bloc, then pull Europe really to try to isolate China. I think one thing that people should remember too is we're talking right now about 20% tariffs that have gone on in additional to the ones that were already imposed on China. So they're probably looking at 34, 35% tariffs. That number is only going to go up, I think, in the near term. So that's something that people should consider. But again, from a strategic standpoint, can Trump use the tariffs to force these early concessions to try to isolate China? I think that's probably the big picture goal.
I would just say one thing, and I'd like to hear Jeff's thoughts on it too as we sort of pivot to the markets. I mean, but Scott Bessent was on CNBC today talking about how there's not a Trump put. And a couple of my friends asked me, like, what do you think that he said there was not a Trump put, but there is a Trump call in terms of like the upside. And a couple of my buddies, and everyone, I mean, there's no secret that everyone knows that, Scott knows us here at RenMac. So, what does that mean? What does he mean by that? And I thought one of my views on that was basically that's their way of saying we're going to not protect the stock market, let the markets fall. Hopefully, that pushes the Fed to ease, right? And then as that happens, we're going to get towards the back half of the year and give something people to be optimistic about. So essentially, you're taking the pain now to create the space for fiscal reflation and enthusiasm around tax cuts, deregulation, whatever else, into the next year.
Yeah, and importantly into the midterms, right? Take the pain up front, see the trajectory into the midterms, and hopefully reset things to the point that has more sustainability than the, ad hoc largesse, if we shall say it, of the last 15 plus years. I have no problem with that, and I think that's the right strategy politically, if that's how you want to think about it. If it is the economy stupid all the time, then if you're going to have to, disrupt the economy, make sure you do it early, and people can see it on the back end. I believe that was called Reaganomics as well back in the 1980s, correct? So, I mean, there's that famous Eddie Murphy
Yeah, but
comedy.
he tried to wring inflation out of the system first. I mean, what's going on right now? I mean, there's a bit of debate about it. I mean, clearly they're slowing the economy down. And again, I mean, I think, I mean, when people tell you what they think, believe them, right? Kevin Hassett was on TV a few weeks ago basically saying one of the ways we expect to slow inflation down is by cooling aggregate demand. Well, aggregate demand was already slowing when you walked through the door, Kevin, um, but certainly some of the things they're doing definitely adds to that. I mean, you don't even have to put tariffs on. The uncertainty around the outlook around tariffs will slow the economy down.
Yeah. Well, if you remember the Eddie Murphy stand-up, somebody in the audience, this is 1982, maybe 81, somebody in the audience screams, Reaganomics sucks, and Eddie comes back and says, "Tell me something I don't know," with a few expletives. But it's long now embedded and memorialized in the lore of politics and I guess stand-up comedy. Well, Neil, let's just really quickly hit on these layoffs and the tariffs or the sales. I know you had a post earlier this week, and in your point, and I'm just reiterating a point that you were making before, but you still see this more as that aggregate demand, that slowdown in sales. When you look at respondents from these surveys or these data points, a lot less about tariffs and a lot more about just aggregate demand, correct?
Yeah, I mean, actually, one chart. I mean, I don't, I've been kind of operating on a shoestring budget over here, so I haven't had all my charts and bells and whistles. But one of the things that I've noticed today was that a lot of the increase in layoff announcements was because of bankruptcies, right? Like, so we had a lot of major retailers going bust, to start the year. Those announcements have been in motion. Maybe that shows up in employment later, but yeah, I mean, there's nothing there about tariffs. It's demand downturn and economic conditions, bankruptcies, corporate restructuring. I mean, I don't know what you call. I mean, if everyone's restructuring at the same time, I mean, that could be a problem macro wise. Um, but it's and obviously Doge was. I mean, the government layoffs were a big part of it. I mean, because we're looking at layoff announcements, so the layoff announcements are what they're tracking. But even when you exclude that, private, everything else was up too. So it's not. I mean, that's the number you should probably focus on because we don't know how much teeth some of the layoff announcements have with respect to Doge. But on the private side, I mean, you have bankruptcies. You have all these things that are still going on. So, it was. I mean, layoff announcements are going up, excluding Doge, and I think, but that, I mean, some of that is going to bleed into measures like initial and continuing unemployment claims.
So from a market perspective, one thing that I've done historically is when we see market weakness, I looked first and foremost to the treasury market to see what's happening there, right? Because a contraction in yields would be the fixed income market's way of saying, hey, we're expecting to slow down, or in your parlance, a contraction in aggregate demand, and lower rates support lower inflation, et cetera. And we've seen that, right? The 2-year yield has come in, the 10-year yield has come in. That's the first part of the story. That's certainly something that gets our antenna up and start probing around and looking at other things. The other part of that story is what's happening to spreads. And we have seen an uptick in some of the credit default work. We have seen an uptick in some of the triple B spreads versus treasuries. One of the things that we do, without giving away the proprietary nature of this, is just measure the difference between equity risk and credit risk. And when we see a large increase in the perception of equity risk, that is not corresponding to the same type of increase in credit, it tends to be bullish. And what I would say is, even though it's not pegged here, it's not extreme, we certainly are seeing more evidence that the equity market cares more about this than the credit market does. Yes, credit spreads have moved higher, but they haven't done it in a meaningful enough way to say, hey, this is reflective of recession. The other thing I would point to too is that financials have historically or generally held up very, very well here on a relative basis. If we're really going to pinch aggregate demand, and particularly getting into something that you hit on, which is this proliferation of bankruptcies, or obviously any type of stress, that's going to hit the credit markets, but it will also hit financials, right? So embedded in that, private equity and some of the insurers, but the banks and so on and so forth. And look, a lot of these things are oversold, but they're still very much in trend and very much look to us to be able to rebound. One chart that I do want to show, because I think it's important, and it's something that we've talked about, is what's happening in beta, right? So if you recall, if you're a listener, we talked about this at the time in early December. Beta was running in the 99th percentile. What that means is if you just took high beta names versus low beta names, measured the spread of performance, that performance differential between high and low had never been higher, or I should say, had only been higher about 1% of the time historically, going back over the last 30 years. We warned at the time that beta was extreme, and that, you know, if you had too much beta in the portfolio, unintentional beta, it was probably going to be a problem for you at some point in the first quarter. That's now happened. We've taken this chart, just actually shows it in the second percentile. We've actually moved it to the first percentile. So the reversion of beta has taken place. One of the things that I ask a little bit, and I say it tongue in cheek, but it does have some truth to it, which is the normal contraction of beta, of high beta, what we've seen out of high beta, which you should expect to see when we're at that extreme, has that now morphed itself into the narrative? Has price driven that narrative? And I think that's something that we should keep in mind, because, you know, when the markets are giving you a message, people like to fill in around the pieces to that message. And so the good news is beta is so absolutely oversold here that it probably presents some opportunities. We'll see if that in fact can take some root. But I just wanted to show that because I think it's a really important part of the overall puzzle in terms of how we think about equities. If we have an oversold condition and you haven't taken the juice out of beta yet, or momentum for that matter, then usually there's a little bit more to go. When you've already taken that and it's been a pretty good rinsing, there's an opportunity there for some type of floor. So look, all our work still says we're in an uptrend, albeit it's uncomfortable when we get here. There are several oversold conditions that have developed. The one area that hasn't gotten oversold that probably needs to is the equal weight S&P, and so we'll be watching that, whether or not the equal weight gets oversold. You know, believe it or not, obviously beta, Nasdaq, some of these former leaders have gotten oversold, Mag 7, etc. The question is, do we need to get the rest of the market oversold before we hit some type of pretty good low? The other thing I would just throw out there for people to keep in the back of their minds is seasonality, right? So when we step into March, we step into the beginnings of a decent seasonal trend. So if you look at the diamonds on this chart, the diamonds show the median return, the bars show the average return. The difference between the median and the average is large outliers, right? So if you kind of want to know what happens generally, look at the diamonds. And what you'll see is, with the exception of June, which is a little soft on a median basis, you really still have pretty good returns from this point out through August. So we are entering a period for the equity markets that tends to be decent, albeit volatility tends to go up in the spring and subside in the summer. But I still think that the market overall is in pretty good shape. One area that I think is interesting, the trends are terrible, so I want to be forthright with that. The trends in energy don't look good. The valuation in energy looks great. And what we'd also say is that the stress in the system, the spikes in 65-day lows, the spikes in some of these price-based measures in energy actually look pretty interesting, in other words, capitulative. And so when we also go to measure that capitulation, what we're looking for is whether or not the outflows are excessive. What are we seeing in that? And what we're seeing right now is that there are excessive outflows in the energy ETFs, and that tends to be bullish as we go forward. So I think there's some more tactical capitulation taking place in energy, but I think that's actually relatively interesting. All right, it's everybody's favorite time. It's mailbag time. We're going to bring in our own mailman, Harry Chen, with today's mailbag question. Harry.
Okay, today we have the question from Luke Kawa. And the question is, what combined level of hiring rate plus mortgage rates is the best case sweet spot for bonds in housing activity, given where we are starting from? Thank you.
All right. Thank you, Harry. Let me interpret that a little bit for you. So Luke Howe is asking what combined level of hiring rate and mortgage rates is best case sweet spot for a bounce in housing activity, given where we're starting from. Well, Neil, you're all things housing, so go ahead and take that first.
First, hi, Luke. For now, you guys are not going to be the 51st state. For now, Luke is Canadian for all those of you that don't know, and big hockey fan. He's also a Yankees fan. Don't really understand the link there, but it is what it is. So we're going to do this one on the house, Luke. He used to actually be a paying client back at UBS, but we'll do this on the house for him. I think with hiring rates, to me, it's the momentum, honestly, that matters. I mean, what you want to see is hiring rates going up. You want to see, labor markets on the mend. We don't have that yet. In terms of like what the clearing rate is on the mortgage side, I mean, I think mortgage rates needs to be at least 5.5% in order for housing to work. We're nowhere near there right now, and that's why, I mean, Besant went around saying how we're going to see a big increase in unfreezing of the housing market. Well, okay, but you've already done that for the people that were willing to make it at 6.5%. You need to see rates continuing to decline in order for this to happen. And I guess the one concern that I have at the moment is, number one, you need rates much lower, 5.5% in order to clear the housing market. But to the extent that you have all this sort of fiscal spending globally, if that's keeping the long end more elevated, that's going to make it more challenging for mortgage rates to come down. So just something to keep in the back of your mind. But basically, I would say hiring rates going up. I don't think there's a magic level, and mortgage rates, around 5.5.
Yeah, I would just add to that, our yield impact model, which measures the rate of change and level of 10-year yields and then the impact historically on equities, has actually turned pretty favorable here with this contraction down to 415. So you're finally getting some support. That's for the S&P. Obviously, at some point, I've actually never run it for housing. I should do that. But at some point, you would expect that would also kick into into housing. When we look at the home building names, and kind of all things related, the good news there is that they're oversold and they're at support. So some type of meaningful bounce is certainly in the cards and in the offering. And I would say something, excuse me, to the magnitude of 10, maybe 15% there. I wouldn't play it. That's just not how we are. We're looking for bigger moves. I would sell it on a rally back up to an overbought condition. But it doesn't look yet to be quite primed to start moving. And keep in mind, housing in our work in the technical land started to improve really in earnest back in the kind of mid to late summer of 2022, and that was a very hard call to make because psychologically it just didn't feel like that could possibly be the case, and in fact it was the right call, and now it's weakening. And the other part of that story for us is that in our alpha models, housing back in the summer of last year was getting to levels that we hadn't seen since the mid-aughts of 2000. Now, none of us believe that housing was in the same precarious condition that it was back in the 2000s, but the move in home builders, the strength in home builders, and the risk-adjusted returns that you had received by owning home builders for that 3-year period was unlike anything you had seen other than that 2005 period. So just something to keep in mind. I think there's probably more to go there. What do we have next week, Neil?
CPI is going to be on deck. That'll be the main event. Market's looking for 0.3% on core CPI. I'm not. I mean, this is a February data point, so I'm not expecting that much in terms of tariffs. I mean, I think it'll be interesting to see if you see some kind of companies, or firms getting out in front of tariffs. I mean, maybe that's you see some of that. Although the evidence for this has been quite thin up to now. I expect ongoing cooling and shelter inflation. Obviously, that's not tradable, right? And we'll also be getting the New York Fed's inflation expectations number. I normally don't highlight that, but I think it's important to keep in mind because inflation expectations have been a concern. And we did see that sort of nasty spike in the UMich data, and this is a February data point. So we'll see what the New York Fed number shows. It tends to ask about inflation expectations differently than the UMich number. It tends to be a sort of cleaner read on how people think about the inflation outlook. So I'll be paying closer attention to that.
Steve.
Sure. So Wednesday, we have the steel and aluminum tariffs. We talked about those. Friday is the government funding deadline. So the thing I would watch is actually Monday. I assume that's when House Republicans are going to try to pass, they would consider a relatively clean continuing resolution through the end of the fiscal year, September 30th. And Monday, presumably, would be the vote to proceed to actually have a vote there on the actual bill. And usually rules votes are pretty partisan. And so that's going to be the question is, can Republicans actually remain unified to actually have the vote on that Tuesday? I assume if the bill does move Monday in terms of the rules vote, that the bill will pass and that the Senate will end up just taking it. I think there are probably at least 7 Democratic senators that think avoiding a government shutdown is probably the preferable option, as opposed to trying to impose constraints on the Trump administration that Republicans are rejecting. So that's sort of the thing I would watch. I think where we could potentially see some hiccup, if for some reason Republicans aren't able to pass that bill, I think we're probably looking at more likely a shorter duration continuing resolution, probably another month or so. That's what Democrat leaders seem to be pushing behind the scenes. So I think the odds of a shutdown are probably low. Keep in mind too, it's Friday, so if need be, they could have the weekend to work and reach a resolution before you would actually feel it on St. Patrick's Day. So that's sort of what I'm watching.
Quantify that number for me.
In terms of government shutdown odds, I would say 20.
Oh, so it's gone down pretty meaningfully.
Yeah, I think I was at like 35%
Yeah,
this week.
yeah.
So again, I think that's probably worst case scenario, probably short term.
Got it. Well, we're going to be watching spreads. I think the pathway between a soft landing or the slowdown and something that's a little more uncomfortable is going to be seen through spreads. That'll also be seen through some of the differentials in sector performance. And we'll look for that bounce out of beta. If we don't get a bounce out of beta or a good response from some of these oversold conditions, obviously that's more troublesome. We haven't yet seen a spike in 20-day lows. So that's one of our favorite developed indicators, a RenMac indicator, in looking at those 20-day lows. And so if we see those develop, that's obviously good news in our view, not bad news. So those are the things that we'll be watching. Until then, join us again next week. Until we'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and subscribe to the YouTube channel if you want to see our beaming faces talk about these really, really exciting data points. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.